You can be self-insured within 12 years. In this educational episode, I'm going to address the question, what is the end goal of buying term insurance and investing the difference? And hopefully this will help you understand how to do that on steroids. Get ready. So I'm Doug Andrew. I've been helping people optimize assets, minimize taxes, and prepare for a comfortable retirement now for nearly 5 decades. And I got my insurance license clear back in 1974 and a Series 1 securities license, which allowed me to sell any stock, bond, mutual fund, or anything. And so I was a big proponent of buy term, invest the difference from 1974 to 1980. And I ended up being responsible for over 3,000 clients in 13 Western states. And we were trying to do a good job investing the difference to earn an average of 12% in the market in mutual funds. Now, Dalbar, who studies investor behavior, says if most people buy and hold in most 20-year periods, you'll only average 9.14% based on several 20-year periods in history. And if you earn 9, you're only going to net 6 in a 33% tax bracket at the end of the day. Because if you have $1 million saved and it's earning 9%, you pull out 90 grand, you're only netting 60,000 to buy gas and groceries and prescriptions and golf green fees. Well, in 1980, E.F. Hutton was the brainchild behind the emergence of universal life. And so I'm going to explain the difference between universal life and whole life because Hutton was basically thinking, why don't we sort of buy term and invest the difference under a tax-free umbrella and put it on steroids? And I could see it instantly. So hopefully you'll understand as I go through this, because the end goal of buying term and investing the difference is to be able to get rid of the insurance. It's term insurance. It's going to go through the roof in price when you're in your 60, 65, 70-year-old, and you are going to be paying big premiums. And so the goal is that you buy term, invest the difference, so that when you have your cash accumulated, you don't need the insurance anymore. I think that's rather interesting because the biggest purchasers of life insurance are those people over the age of 65. Did you know that? And they're doing it for living benefits, not for the death benefits. So let's go back and look at this. I'm going to simplify this. When I first started in 1974, all insurance companies had to use the 1958 mortality table. That's how many deaths per thousand in America. And then they adjusted in 1980, 2001, 2017. This is called the Commissioner's Standard Ordinary Mortality Table, otherwise CSO. So just to help you understand it, I sort of like the old 1958 tables because for 30-year-olds, there were 2.13 deaths per thousand. 40-year-olds, 3.53. When you were 65, it was 31.75 deaths per thousand. At age 80, it was 109 deaths per thousand. And so if you wanted to calculate the cost of insurance, the pure cost, then if you had 1,000 30-year-olds that wanted to put money in a hat and they wanted to come up with a $1,000 death benefit for the 2.13 of them that were going to die that year to give to their beneficiaries, everybody would have to contribute $2.13 to the hat. They'd have to collect $2,130 so that they would have enough to pay $1,000 to 2.13 people. Does that make sense? And so it goes up. And so term insurance, it's not really a straight curve like this. It's probably more of a curve like that. But let's keep this simple. So when you're buying term and investing the difference, you're paying less premium, but you're taking the difference between what maybe a whole life policy would cost, which would be this. And so your whole life policy might be charging you $31 per thousand. But see, you're way overpaying for the insurance the early years in whole life so that you can keep paying the same premium for your whole life. You can underpay. When the insurance gets too expensive, your policy premium doesn't go up. It's guaranteed. It pays that death benefit for your whole life if you pay that minimum premium, okay? Well, a lot of people, including myself, I did all kinds of studies and I said, well, if you could buy term, and if you invested the difference and you dollar cost averaged, and if you earned 12%, you would outperform the whole life, okay? Because I had to remember earning 12% before tax is only like really netting 8% that's tax-free in an insurance policy. Well, that's what you could do, but Dalbar says most people are only earning 9% if they buy and hold. If they retire and the market goes down, they get impatient and they sell when the market goes down. And they wait and buy high. So the average retiree is only earning 3.5% return in the market. But see, in 1980, and even before that with whole life, people wanted to pay even more into it and be done paying for their life insurance at age 65. Because they had enough cash equity, it's called cash value, accumulated in it. So that would be maybe paid up at 65. They don't use that term anymore, but you wanted to be predominantly through based on the average dividends or interest rates at age 65. Then they said, well, let's pay premium for 20 years. How about 10 years? Well, what E.F. Hutton said, why don't we let people, if they want, pay it in 1 year. In fact, when they first started, people were throwing in $500,000 into universal life back in 1980. And my clients were never happier than when I got them out of the market. But they could put in $500,000 and they were earning 11.75% to 15.5% from 1980 to 1991, 1992. And so they were able to earn 11 and net 10. That means they could put in 500 grand and immediately start pulling out 50 grand a year tax-free. Well, because the banks and the brokerage firms could not compete, they lobbied Congress, and in 1988, they passed the Technical and Miscellaneous Revenue Act. Technical and Miscellaneous Revenue Act spells TAMRA, okay? And so you had to spread it out over a 5-year period. So now it's sort of like a 5-pay, whole life. If you wanted to maximum fund that, it's called a 7-pay, okay? And so you get the money in. If I want to put in $500,000, I can put in 100 grand a year, each year for 5 years, but then I'm done. I can't put any more into it. But you are putting way more money in here. And if you're a 60-year-old, you put in $500,000. Let me show you what happens. I many times compare IUL to a bucket. So if I'm 60 years old and I want to reposition $500,000 to increase the liquidity, safety, rate of return, use it for tax-free retirement income, but I don't need to start taking out income immediately, I can design an IUL to accommodate $500,000. Now, once I know that, that's called the guideline single premium. And the calculation is for male age 60 under TEFRA and DEFRA tax citations, you want the least amount of insurance you can get away with. So for a 60-year-old, that's about double that, $1 million. Yeah, I know you could buy way more insurance than that for $500,000. That's not the objective. You want the least amount of insurance. So this is a $1 million death benefit, but you put in $500,000, and if your objective is to have the highest net internal rate of return, then this allows you to have this cash as it's put in there and grows, qualify as part of that death benefit, which will mean the insurance will get cheaper as you get older. Have you got that? Let me show you what I'm talking about. You put in 100 grand the first year, 100 grand the second. And by the way, this is the first day of the second year. You can have 200,000 in there. So in 4 years and 1 day, I can have my 500 grand in there. Now, if I die in the 5th year, then the insurance company is going to pay out $1 million. Yeah, it's twice as much as I put in. That's not why I did it, was for death benefit. But the insurance company is only charging me for the differential, the net amount at risk. If I have $500,000 of cash value and the death benefit's $1 million, they're only on the hook for $500,000. They're only going to charge me for insurance. I'm 5 years older. Even though the cost per thousand went up a little bit, the amount of thousands I'm paying for is half of what it was 5 years earlier. Let's go 7.5 years. Why 7.5? Because I have averaged since 1980 9.62% rate of return on my universal life and indexed universal life, both. And so if you use 9.6 and divide that into the rule of 72, your money will double every 7.5 years. So we've had many, many people who have experienced this. That $500,000 doubles to $1 million in the 12th year. So in 12 years into the contract, your cash value equals the death benefit. So you now are self-insured. People who buy term and invest the difference, they don't hit that end goal of having enough cash to get rid of the insurance until 30, 35, 40 years down the road. And in the meantime, inflation has eroded away most of that. And so the end goal of buying term and investing the difference is to be able to get rid of the insurance. And most of the time they can't do that for 30, 35, 40 years. I can do it in 12 years with Universal Life. That's why I call it buy term, invest the difference on steroids. So I have $1 million in the 12th year in there. Now, I could start pulling out $100,000 a year tax-free, but if I want to let it sit there and grow, it'll double in another 7.5 years. So by the 20th year, it's got $2 million in there. Well, what if I die? Does it only pay out $1 million? No, Tefra and Defra says the insurance company will pay 5% more than your cash value. That little amount, that 5% more. So if I died when I had $2 million of cash in there, the death benefit would be $2,100,000. The insurance company is only charging me the actual cost of insurance. It's term insurance. Every whole life, Universal Life, all has a term insurance cost, a term component, okay? But they're only charging me for the net amount at risk, that $100,000. The cost on that insurance in 20 years, even though I'm 20 years older, is minuscule compared to the interest I'm earning on $2 million. Many times I have earned on my Universal Life 10%, 15, 20, 25%, 61%. I mean, 25% on $2 million, you make another $500,000. The cost of the insurance would be a few $1,000s. Many times, all of this interest that you're earning dwarfs the actual cost of insurance. You are self-insuring. You are buying term, investing the difference, and hitting the end goal in as early as 12 years. If it takes you till 15 years, that's okay, even 20 years. But you don't have to wait until the 35th or 40th year to finally have enough money that you can get rid of your death benefit and get rid of paying for insurance, because it's taken care of really fast when you maximum fund an IUL. Does that make sense? If this is intriguing you and you want to learn more, I want to gift you a copy of my most recent best-selling book called The Laser Fund, and it's actually 2 books in one, 300 pages total, but this side is for the left brain learners, and it's about 200 pages, 14 chapters with all the charts and graphs and explanations. If you're more of a right brain learner, you flip it over to this one, about 100 pages and 12 chapters with 62 actual client stories. If you want to use both your right brain and left brain, read both books. But you can go to Amazon, and I think it retails there for $20. You pay another $10 for shipping and handling. If you do that, thank you. But you don't need to do that. I'll gift you a copy free. Simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I will pay for the book. I'll fire out a hard copy to you via priority mail. And in that site, when you're claiming your free copy, if you'd like to listen and learn or watch and learn, check out the audio and video formats. We teach educational webinars on a regular basis. There's no charge for those. You can even schedule an appointment with an IUL professional that knows how to structure these correctly. But this is why the goal of buying term and invest the difference is to eventually have enough money that you no longer need the insurance. You can accomplish that probably in 1/3 the time with a properly structured IUL.